Give and Grow, what's going on? This is Ryan. This is Eric. We're back at it again with another podcast episode. And I just wanted to start off by just saying, as of this recording, this is September the 6th. I just want to thank y'all for all the love and support on the YouTube channel and all of our socials. Just thank you for coming out and supporting us. This has been a very fun ride so far. We got some big goals for Give and Grow.
Yes,
and
sir.
We really hope that a lot of the stuff that we've been kind of throwing out there has been helping you, giving you new information, giving you insight on things.
You know, what's funny, the last time we recorded a little podcast episode like this, we had a pretty red day in the market, and
Yeah.
lo and behold, here we go. I guess that was the weekend after, but this is the day of. But man, what another crazy day in the market.
Yeah, that's kind of crazy. That was the 20s and 30s episode was like right after, I think
it was like...
It was like the week of the yen trade, I think, was when we recorded that. I think, markets were down a lot during that time. We have a topic that actually Eric wanted to talk about today. What is our topic for today?
Wealth preservation.
Wealth preservation.
Yes, sir. Yes, sir.
What made you want to talk about wealth preservation just before?
Well, just thinking so much about investing, accumulating over the years, all the different systems, selling options, dividend income, if you get into real estate, the passive income from that. All these different ways to cash flow and grow your assets and, think about appreciation. But what happens when you hit those big milestones, like when you become a millionaire, $5 million, $10 million, because when you either want to live off that and retire, you kind of have to change the way you invest. You want to be a little bit safer, you don't want to, if I'm 65 about to retire, I don't want to risk, a 50% drawdown.
Oh, no.
I would still invest through it. But if you're trying to go by the 4% rule, I mean, imagine, if you have $1 million, all of a sudden it goes down to 400K and this is your first year of retirement and you got to pull, 4% of that, that's going to be scary.
Yeah.
That's a lot. When you deal with large numbers, you think about just keep the system going and you feel good and the cash is coming in. You don't often think about the psychology when your accounts are going down. So my question is, when I go to retire, one day when I want to leave this money for my family or our families and, our business, I want to make sure that we're not only growing, but we're protecting our money, we're hedging it.
Yeah.
We're being safe. And so, yeah, I've been thinking about it a lot this last year. I find it really interesting, studying different types of investing vehicles that they're not as sexy, but they're safer. One of the big ones is gold. And we're gonna get into all that in a little bit, but the topic of wealth preservation just really it gets me excited. As
a culture, especially here in the States, because it's probably going to be different everywhere you go in like different countries, but specifically here in the States.
Yes, sir.
How do you think that people do with preserving their wealth, just like over time? If you were to like throw out like a 0 to 10, how would you rate America and like the consumer on preserving their wealth?
I'd say a 4. That's not going off analytics or statistics or anything like that. I just know in general, they say the first generation makes the wealth. Second generation typically blows it. Third generation builds it back up.
Yeah, the vicious cycle.
Yeah. But that's not for everybody. I mean, I think you can look at a lot of people and really good examples and see if they have preserved wealth over the years. Different companies, different CEOs.
But what about like
now
regular
just
people?
general people? I'd say a 4 or 5. I don't think people have the discipline. Like they're not thinking about how much can I continue to grow this, but also how can I keep this protected for the next generation and the next generation. I think it's more of, I'm going to live the life that I want to live now. My family has left this to me. I'm going to enjoy it. And that's not everybody, but I would say, and that's not backed by anything, but if I had to guesstimate, I'd give it a 4 or 5. What do you think?
I definitely agree. I would say that most people now don't really have that mindset where it's like, oh, well, I want to work hard to leave things for my family. Most of the wealth that has already been passed down was probably already squandered by like a lot of people.
Oh, yeah.
And now, like what you're saying, they're kind of just living like there's no tomorrow. I would say that the way that our economy and our culture is, it's pushing the idea of, you only live once, which even though is true, it doesn't mean that you can't have a mindset of like, oh, well, what if something happens and I need money, or, I want to be able to leave something for my family, or, whoever in this case. I think that, our culture is very big on like, you only have the one life, just live it up. That's kind of like a double-edged sword, because, I want to be able to do that, but I don't have the resources or the time to do it. Yeah, I'd probably give it around like a 3 to a 4. I would say going into future generations, I think it's going to be much harder.
I think if you don't build it, you don't appreciate it.
Oh, yeah.
Same way.
Yeah.
And I think that's important. That's something, if the Lord ever blesses me with a child, that's something I'm really going to try to instill, making them understand, you got to work for this. You know, there's a system behind all this. You don't just get to wake up and have this. And I think that's a big issue a lot of families have, is you have a lot of spoiled children, entitlement, and they don't even understand what it took to get to that point.
Not only do they not understand it, they don't know how to do it. Because, if you grow up like really rich and you're just given everything from your parents and stuff like that, and they're not teaching you how they did it, then for one, you're more likely going to squander the money that you got. But then it's like, how do you build it back up? And then that's why you have a lot of people that it's hard for them to feel like they can't really get past a certain point because they don't have the knowledge to do so. And that goes for like pretty much everybody, because if you grow up poor, unless you really found like a mentor or someone like that to like help teach you these things, or you did research, it's hard to see past that line, and you're just like, oh, well, this is never going to be attainable for somebody like me, which is not true. It just takes a lot of discipline, like what he said, a lot of discipline, a lot of kind of like seeing through the noise, seeing through the facade. But you got some stats that you wanted to talk about.
I do.
I know I
did some case studies. The first era that I wanted to look at was 1970 to 1980. So during this time, you had a lot of inflation, you had interest rates that were really high. And so what I did, I took the S&P 500 and I got its average return over those 10 years from 1970 and 1980. And believe it or not, it was actually 14%. I was surprised by that. It was much higher than I thought it would have been. But that's really good. I mean, that just shows you, if you invest through those times, you're still going to get a good return.
Yeah.
But I wanted to compare it to something. I wanted to compare it to gold, and I did. And your return, if you were in gold during this time, the average for those 10, 11 years was 30%.
That's crazy.
Yeah. When you talk about a place where you can store your wealth, I still think the metals do that. Gold is obviously the standard, and then, silver's not bad. I guess copper is okay, but I don't really consider it like a place where you can, I don't know. I need to do more research on copper, honestly, but
I've seen platinum be a pretty decent one.
Yeah, I've heard that.
That one's probably, I think, around the same with like silver. It's not as like popular as silver. When I researched like, the metals, like platinum was always in that list with like gold, silver.
Oh yeah. Now I know, history doesn't repeat itself, but it does rhyme. And I think, the era that we're in right now possibly could be similar to the 70s. So with that being said, I do plan to increase my gold exposure.
Yeah.
And some of it'll be through call options like leaps, 1-2 years out. Then I just want to slowly build a position. And I think after doing all the history I did over the last couple of days, I always want to have a good percentage of gold in my portfolio, no matter what. Obviously, it's not compared to the S&P 500. Obviously, it's not going to outperform head to head, for the long haul. But it's going to be safe when there is risk in the market and volatility, and that's what you're looking for during those times. So yeah, I like gold. I'm excited about it.
What is it about gold that makes it an asset that can survive, the test of time? You know what I mean?
I was going to say, that's the beauty about it. It's time tested.
Okay.
I mean, it goes back to, like you've said it in other videos, back to when you had castles protecting their gold.
Yeah.
When you just think about chemistry and the periodic table, how valuable gold is to society, to the things that we create.
Yeah.
Silver too, when it comes to electricity and energy, all these things gold has value in. And so you can make paper dollars, as Peter Schiff likes to say, it's fake money, or maybe it's Robert Kiyosaki, who cares. Not saying I promote what they say or anything, but I do like to listen to them every now and then. But at the end of the day, when things start getting crazy globally in the economy, when it comes to currencies, you strip all that away and it's derived, you're left with one thing, and that's the precious metals. That's gold and silver. It's time tested. As long as they're a thing, I will continue to value what they can bring to my portfolio as far as hedging and protection. And so, really, it sounds silly to say that, but it's time tested. And that's what I like.
Yeah, I'd say that you can probably lump them all together. Obviously, I think that gold and silver and, the precious metals, I would even throw real estate in there. Because pretty much assets that are so needed that when you strip everyone down to it, people need places to stay, right? Gold and silver, they're basically assets that are used in pretty much everyday life. If that utility is great enough for people to assign value to it, it's going to be something that's going to be very, very valuable. I think that gold is probably going to be at like the top of that list because when you strip everything down, to its core and you're left with just something that's tangible.
Yes, sir.
Gold, silver, those things are going to be during times of downturn in like markets and downturn in the economy and like recessions. Definitely gold, definitely silver. Would you consider cash to be a good thing just to have in general during those times? During like recessionary times?
So let's pretend like we're making a portfolio. We're roughly 65. We're about to retire, and we're not necessarily so concerned about total return. We just want preservation, like we're talking about. We want it to be consistent. So we're just going to kind of have 4 pillars. Let's just say we split it up 25% each. So right now we talked about gold. So we got gold in one section, 25%. We're going to take this thing at the end and we're going to test how it would have done in the Great Depression compared to just having stocks or just having real estate or just being in cash. But cash is interesting to me because, it doesn't just have to sit in your bank. Nowadays, it can sit in a market money fund, almost like it's basically in short-term treasuries or T-bills, and it's just collecting the short-term interest rate. So, like right now, until September 18th, you're collecting between 4 to 5% on your cash right now, and I think that's very attractive. I mean, I think Warren Buffett would agree with me.
It's something.
And the beauty of that, you're getting that 4 to 5%. But there's really no downside risk. I mean, unless like the U.S. government, shut down and try to take all your money from you. But that's right. That's extremely unlikely. Lord help us if that happens. But so I think that's another section you can have. But I for my study, I actually use the 10-year T-bonds.
Okay.
Or just 10-year bonds when I was going through 1929. But we'll get to that in a second. So I like cash. I really do. I don't want cash just sitting in the bank only collecting minimum interest.
See what I was going to say too with that, going back to like the old times, back in the 60s through, the 80s, whatever.
Yeah, you didn't necessarily have that.
Right. You just had cash, like paper sitting, like imagine all those people back in those days that just had all their cash under their bed or like in like some random like safe or whatever, collecting nothing.
Right.
Like it wasn't making anything. But now, like what you said, like you can have your cash in like a money market fund. You can have it in like a high yield savings account. You can do all these things with your cash. Just park it somewhere, let it collect interest. And there's no downside risk, which is why, we talk about it being a pretty decent thing to have during these downturns to preserve your wealth.
Yes, sir. Absolutely. So, yeah, I mean, cash, short-term T-bills kind of be the same. I think technically the 10-year bond is kind of its own category because you have to be, more committed to that. Or you could be invested in like an ETF, like TLT, something like that.
Yeah.
But yeah, those are both viable options for sure. But yeah, so we talked about cash, we talked about short-term treasuries, we talked about the long-term bonds, we talked about gold, and then real estate. I didn't really scan real estate from 1970 to 1980. I did during the Great Depression, and it basically performed like the stocks did, equities.
Gotcha.
I want to say from 29 to 39, the return on real estate was like -1%. And that was the same for the stock market as well over that decade. So I thought that was interesting. But another thing, really to me, the power in real estate is the cash flow that you can get.
Yeah.
So I find value in that. I want to say in 1929, as the Roaring Twenties were kind of peaking, the average rent was between $40 to $60. $40 to $60. That's crazy.
That's wild.
But during the 1930s, because deflation was insane, the average was $18 to $20. So think about that for a second. If you owned, apartments, if you rented out homes, if you were relying on that salary as your income, that stuff, it was cut in half. And so the average cost of living during 1929 was between $4,000 and like $4,500.
Golly.
So now if you had 30 rental properties back then, or apartment complexes, homes, whatever, you probably still could have made it out okay. If you were making $18 on each one, but I don't think a lot of people had 30 rental properties back then, unless they were extremely wealthy.
Unless you're Potter from a Wonderful Life.
There you go.
You had everything.
Go. Yeah. So I think real estate definitely is valuable. I look forward to utilizing it. Physical real estate one day. We'll talk about that in another video, getting into some fun projects that are coming up.
Oh yeah.
But yeah, I like real estate, but when things begin to crash, it's not necessarily a place people are going to run for safety.
Yeah, I agree. And one of the biggest things about real estate when it comes to wealth preservation is normally, if you studied over time, the economy and inflation coming back, what do they do to bring down inflation? They raise interest rates. They want to constrict the economy and constrict economic activity so that, inflation will come down and, they'll have price stability and all that stuff, everything that like Powell's been saying for the past 3 years.
Yes, sir.
If interest rates are high and you have like these homes that, have a pretty big mortgage on them, that those payments are going to start stacking up. Also considering too, if the consumer isn't doing very well, it might be hard to justify you finding, a tenant that's willing to pay the rent that you want to give. So you have to lower your rent. So you're paying a lot of money in like interest, and you have to lower your rent because, you got to meet the demands that you have during those times.
Yeah, if you can't keep somebody in the house, then you're not cash flowing.
Right. So
exactly. You got to adjust to make something.
Right. And if no one wants to rent from you, that house is sitting there just consuming your money. And that's the thing though, is that what's good about real estate too though, is that like over time, real estate is one of the best wealth building tools that you can have, because not only do you have cash flow, you have a capital appreciation in general with it. The thing is that during those downtimes, it's possible that the real estate market might crash, but you have to be willing to weather the storm and kind of wait and just get through it. Yeah. Because eventually it'll come back.
Just keep that cash flow coming.
Right. Now, and this is why though. This is why I think when it comes to real estate, I find it very interesting, the people that try to pay down their mortgages on their real estate properties.
Okay.
Like think about like Dave Ramsey. Dave Ramsey ain't sweating during recessionary times. Outside of his business with, Ramsey Solutions, just think about his real estate. They're all paid for.
Yeah.
So it's they're not, there's nothing that's going to be coming for him because all of his properties are all paid off.
Yeah.
Now that's very unrealistic.
Yeah.
But that's something that one could consider being something that, they could work for. Like they can work towards having rental properties that they get paid off. If something like this happens, they're not paying mortgages, they're only paying property taxes. and they're not going to be hit as much as someone that over leverages themselves
Yeah.
into many properties.
I mean, I'm just making this up, but if you're Dave Ramsey, instead of making 10 million a month, you're gonna make 5 million a month.
Yeah.
you're gonna make it.
Just to kind of like break all this down, because you mentioned kind of like the 4 separate pillars of things that one should or could or should consider when going into downtimes. You said the first one was like precious metals like gold, silver.
So let's say 25% gold. Let's say you did 25% in long-term or 10-year treasury bonds.
Okay, that's 2.
25% in real estate.
Okay.
25% in the S&P 500.
Gotcha. Okay, gotcha.
So
that's what it is.
If you would have done that, so the average return of real estate, we said over that decade from 29 to 39 was negative 1%. The average return of real estate was negative 1. S&P 500 was negative 1. Now, if you were in gold during that period, it was 5%. If you were in the long-term T-bills, it was 4%. So if you add all those up and divide by 4, I think it would have been close to a 2% return during that decade.
Okay.
So imagine if you were just in the S&P 500, you would have actually, like I said, you'd have been negative 1%. So,
Crazy.
I mean, and 2% isn't like this crazy big difference, but when it comes to spreads and preserving wealth, I'd rather be making money during that time. Because if you have $1 million and you make 2% over a decade, during that time, that's still a lot of money.
Oh, yeah.
You're going to be fine. You're going to be okay. And that brings up another important point that I learned throughout all this. Having a lot of assets is, I mean, you're kind of like, all right, Captain Obvious, but the more you have, the easier it's going to be for you to get through those hard times.
Right.
Yes, you're going to have to cut back on some things a little bit, but for the most part, your life's probably not going to change too much. Now, obviously, like the Great Depression is a little bit of a different situation because so many people were on margin. They were borrowing money, but that's not really true wealth, in my opinion. You know, but if you have true wealth, you know, low debt, lots of assets, well diversified, you made it through that time.
Oh, yeah.
Kind of brings me to my last point. Like I said, I went to 1929 through 1939, and pretty cool. A website I found, you could simulate, because obviously you couldn't invest in indexes back then. They had some mutual funds, but they weren't really popular, but you couldn't invest in like the S&P 500. That wasn't even a thing yet. You had like the Dow Jones, I guess the S&P 90 or whatever, but you could still buy your equities. But this website kind of simulated if you could have invested into the S&P 500 back then, what the price would have been, and it connects to now. So I was able to take that time period from 1929 to 1939. I said, okay, now obviously having $1 million in 1929 is kind of extreme. That means you were like the Vanderbilts, the Rockefeller. That was a lot of money. But when it comes to wealth, preservation, I think that's a good number just to start with. So that's what it's some people had it back then. Obviously, most people did. If the cost of living during that time was, like between $4,000 to $10,000, obviously a lot of people didn't have $1 million. But we're going to use that number. So what I did, I put in $1 million at the beginning of 1929. So from 1929 to 1939, guess how much that $1 million turned into?
I guess like 8 million.
No. 1929. This is during the heart of the Great Depression.
Oh, during the heart. Gotcha.
Yeah. So 1929 to 1939, you ended up with $894,516. Since you had that much money, if you were fortunate enough to have that much money back then, you were okay.
Yeah.
You still got. I looked at the dividends. The dividend percentage actually went up if you were in equities. But like I said, this was based off if the S&P 500 was around. So technically, like the dividends from like 1929 to 1931 were between 4.53% to 9.72%. So let's just pretend you took 1%, like your 1 million. I think the first year it went down to like 700K. But if you just took 1% out of that and lived off those dividends, you still would have been okay.
Yeah.
So I found that interesting. But get this. If you would have just, if you had the ability and you still cash flowed through your real estate, you left your investments alone in this simulated S&P 500. So from 1929 to 1939, obviously your 1 million would have gone down to 894K. But what if you would have held on and kept investing Well, this isn't even including more investments you put in. This is just letting it continue to grow. 10 years later, you would have had $2.1 million. So at the end of 1949. And then this is the craziest part, man. 10 years later, that 2.1 million at the end of 1959 would have been $12 million. And the Great Depression, out of the history of America, is definitely, it's probably the worst financial situation in America's history. I don't think anyone would argue that.
No.
There were some other ones for sure. There were some panics that were really bad, but I haven't really looked too much into those. But I mean, so it shows you the power of why you got to keep going. You got to keep investing. So I did another little study. We always talk about having cash, right? So if you would have had $1 million, but you had 20% in cash on the sidelines just in case something happened. So I did the math. If you just invested that $800K, it would have turned into like, I think it was like $1.7 million.
Yeah.
But if you would have taken that $200K and invested it in that first decade from 29 to 39, it would have been like $1.1 million. So you combine that, you would have ended up, I did the math, you would have ended up with $700K more versus just leaving that whole 1 million alone.
Right.
Does that make sense what I'm saying?
Yeah.
Yeah. So if you just had that 1 million by itself versus you had 80% of it invested, but then 20% in cash. And then when the S&P 500 theoretically would have hit a bottom, if you would have invested that 200K in at that bottom, then you would have ended up with, I think, like I said, it was another $700,000, almost $1 million more dollars. So that shows you the power of having the cash available when hard times come.
Right.
And that really sticks with me. Yes, sir. So just to kind of bring this all home, the most important thing I realized with studying the 70s and the 30s is having cash available. When everybody else is running like a chicken with their head cut off, if you have the ability to buy assets for pennies on the dollar, that's when you're going to make so much wealth. I was reading a statistic to you about there was more millionaires made than the Great Depression than almost any other time period in America, and that's because they had the cash ready to do those things. They weren't leveraged up. They weren't sunk in debt. They had the cash. They were ready. And then at the same time, you want to have good cash flowing assets with good quality from your real estate. You want to keep stacking into your S&P 500 index. If you want to use QQQ, if you want to learn how to do options, selling options, collecting premium that way. But either way, if you don't have the cash available when these crashes happen or these economic storms, you're not going to be able to take advantage of it. And this is, when you can buy with a margin of safety, that is the most powerful tool when it comes to investing.
I also want to bring up too, to kind of like wrap this up as well. It takes you being mindful of these things. And we talk about psychology of money a lot. We talk about the mindset that you should have when you're looking to preserve your wealth. It starts with you understanding, like what he was saying before, the times that come when you want to be more on the defensive, the times that come when you want to be hopping back into stuff like equities or real estate or even like crypto, those like risk on assets. It takes you having to understand the time period that you're in. You got to keep up with what's going on in the economy, with what the government's doing, with what the Fed's doing, even stuff like the election. All of these external things are playing a role into how your wealth is going to be affected, which is why it's important for you to be on top of all these things. You can be someone that can bury your head in the sand and kind of just like be like, oh yeah, well, I'm just going to just not think about it, not worry about it. You're probably going to end up getting swept away, in the current of like recessions and downturns. You should always be trying to plan for the next steps. And when you have the stuff like cash or other types of things that can be able to set you up during those down times, that's when you're going to be making a lot of your wealth. But it just takes you having to actually put in the effort. It starts with you understanding that no one's going to help you. You have to figure these things out on your own. It's okay to get information and be taught, but it's your responsibility to make the right choices, to make quality decisions, like what he says, and really set yourself apart from the culture, because the culture will tell you that the sky's falling, that you need to sell everything. They tell you to spend all your money on things that are probably not worth it, that
You only live once.
Yeah. See, they tell you those things. But what we're telling you here is that if you were to really, really focus and understand and learn the cycles of the economy, understand compound interest, understand that a lot of things in this world are truly not really worth it, and that you can have a life eventually, because building wealth takes time, where you don't have to answer to somebody. You don't have to be this person that is being taken advantage of by like other people. You're the one that will be setting the rules for your life.
You're building a beautiful garden. You're just doing your job, and you're keeping it going, and it's going to continue to be a beautiful thing for your family and the next generation.
Right.
That's what this is all about. That's what Give and Grow is all about.
Right.
Well, man, I enjoyed this. Great conversation. Anything you want to add? Anything?
Oh, no. I just want to say thank you for all the subs, all the likes, the comments. Things are definitely turning up for Give and Grow. I've really been enjoying doing a lot of the content that I've been doing. I'm not sure when this episode will come out, but hopefully by that time we can look back and say, man, this has been doing very, very well. And we're hoping to be able to hit that 1,000 sub mark by the end of the year. And just thank you for everything that y'all have been allowing us to achieve on this channel.
Absolutely. Until next time, let's continue to give and grow.